SVN Miller Commercial Real Estate. I have the honor to sit in for the Executive Managing Director, Brent Miller, who wasn't able to be in the office this morning. And so that gives me the distinct pleasure to sit here with Wes Cox, who Wes Cox is a senior advisor with SVN Miller, and he's also part of the renowned Henry Hanna team, who we all know and love. So I want to start off by thanking you again for joining us for part 5 of our 6-part virtual series, Shifting Gears. As most of you know, our annual conference real estate forum is usually held right here in the town of Salisbury. And unfortunately, with the COVID-19, which has altered kind of all of our lives over the past several months here, we kind of had to do something different and make a change. One of our missions here at SVN Miller and SVN in its entirety is to create amazing value with our clients, colleagues, and communities. So that being said, we wanted to figure out what we could do, and we didn't want to cancel it, so we shifted gears because this is our 11th annual forum. And people anticipate it each year. So they come in, usually Wes is speaking on a podium in front of, several hundred people, and they're there to find out about commercial real estate. They're there to find out about the economy, what's going on with development, and where we are heading. So we did not want to cancel it. So instead we wanted to deliver and give you guys another virtual meeting to attend, as if you don't already attend too many. That has kind of been the way of life here. And so, that being said, I'm sure there's several virtual meetings you can attend daily. So we do appreciate you tuning in today and taking the time out of your day to tune into this one here. So like I said, it's part 5 of 6. So if you missed any of the previous series, you're more than welcome to view them on svnmiller.com or our SVN Miller YouTube channel. We have them all recorded. And also, in order to make this forum interactive as possible, we encourage that you ask questions. So during the presentation today, if you have any questions, put them in the Q&A box. We'll be watching those, and at the end, we will try to answer as much as possible and go from there. So anyways, I will turn it over to Wes Cox, like I said, our senior advisor here. This is his show. I'm just co-hosting right along with him, but like I said, he's usually in front of 300 people doing this. So, but without ado, here's Wes Cox.
Thank you, Rick, our newly appointed managing director. I wouldn't go as far as saying it's my show, but I tell you, it's probably more intimidating talking into a camera than in a wall behind me, as opposed to a few hundred people. So I'm sure our speaker can agree with that once he goes live with us this morning. So before we get into the meat of the meeting today, first love to thank a few people that helped make this event possible. As Rick said, we pivoted from our live event into this virtual series. We broke it up into 1-hour sessions, and in order to do that, it took a lot of planning in the background. So first, I'd like to thank our friend Mario from Salisbury University, where we normally host this event. They've been phenomenally supportive of us and allowing us to use their software to make this work for everyone. Then we have our sponsors, of course. They've hung in with us, although we couldn't be there in person. M&T Bank has been a very loyal sponsor with us. Thank you, M&T and Monty Saylor, for that. Delmarva Veteran Builders, who you saw, I believe, in our first event. Thank you guys for also being a loyal sponsor. Merrill Lynch and Bank of America, they stepped up this year and partnered with us. And of course, they were a host last week with a speaker out of their Manhattan office. Hebron Savings Bank, also a loyal sponsor. Thank you guys. The insurance market, you saw Jim Hartstein come and introduce one of our speakers earlier as well. I believe that was Annabelle Sue. So thank you, Jim, and your whole team. Other sponsors, Bank of Delmarva, Farm Credit, Avery Hall Insurance Group, TRS CPA Group, and WR McCain & Associates, a valuable partner that we personally use on a daily basis as their expert appraisers in the market. So our committee that helps with this event, of course, Amy Miller. Amy's with us today. Thank you, Amy. And of course, Brent. Rick to my side. Rick was a featured speaker at one of our earlier sessions. Tony Ensley has been instrumental in helping planning and giving us ideas for this event. Steve Evans, Kelly Jeter, and Amber Bostwick, who's helped make all of the technology happen for us. So that being said, let me go ahead and I'm going to go ahead and introduce our speaker now. Let me Make sure he is on. Okay, looks like Kevin's with us. So this morning, I have the pleasure of introducing Kevin Maggiacomo. Kevin is the president and CEO of SVN International Corporation. Under Kevin's leadership at SVN International, he's helped propel SVN's expansion across the globe from 7 offices in 2001 to now more than 220 offices in over 8 countries today, hence SVN International. During his tenure, SVN has twice been named to Inc. magazine's list of the fastest growing private companies in America. In 2016, Kevin was named by his industry peers as a commercial property executive's executive of the year. What an honor. Executive of the year for the entire nation. Great job, Kevin, on that one. He's a member of the Young Presidents Organization and also 2 international chief executive think tanks. I'd love to be a fly on that wall. He also serves on several boards. I won't go through them all here today, but he is on one of them. He's on the National Association of Realtors Commercial Advisory Board, as well as a plethora of others. So just a few personal words I'll say about Kevin as part of this introduction now that kind of the formalities are over with that. Kevin is not just a visionary leader who tirelessly promotes ethical practices within the commercial real estate industry, which he does, and we see it every day and every time that we hear him speak. He also truly cares about his team, not just his executive team that he interacts with on a regular basis, but also us, the advisors around the country. He cares about every single one of his team members. Kevin treats us like the client. So that's why his reputation is what it is in the industry. So he's not just a CEO. He's our friend. He's not just our friend as well. He's also addicted to visiting us here on the Eastern Shore just because we have some of the best fishing in the world. So he will concur with that, and we love having him when he is in town. But also another personal note, prior to everything that's been going on in the world today, not the world necessarily, but America, Kevin's been a longtime champion of supporting diversity in the commercial real estate industry. Commercial real estate industry severely lacks in that area. And just by evidence of our executive leadership team, as well as our advisors around the country and the growth of the diversity within our firm, he's been a champion of that. So I am proud to turn it over today to our friend and CEO, Kevin Maggiacomo. Kevin, it's all yours, my man.
Thank you, Wesley. Thank you, Rick. You're too kind, and I truly can't get there enough. World-class fishing, passion of mine. And, I'd be remiss if I didn't just piggyback on a comment you made. The subject of today's talk is not diversity and inclusion, issues and opportunities. But for the audience, we are firm believers. And I think as an industry, would serve it better if we proactively and intentionally sought to leverage 100% of the population and not half as we build our teams and as we redesign, not rebuild, but redesign our companies for the next generation, long-term and even short-term on the other side of COVID. Just my 2 cents there. So thanks again. And thank you to the audience as a whole. It's great to be here this morning. It's always a pleasure to connect, even virtually, with a group of real estate and business professionals who convene and collaborate locally, as does happen quite often on the Eastern Shore. So you heard I am the CEO of SVN International. We are a full service commercial real estate advisory. We're in more than 500 markets, more than 15 product types are practiced under the brand, and our geographic coverage is highly diversified. Now, I only say that because my domain and SVN as a whole extends well beyond the Eastern Shore, is more macro level in nature. And that's the level to which I'll keep things today. So a little bit of background in terms of why I'm going to be at 30,000 feet for most of the time. And we can get into some of the Q&A and nuance this thing near the end of the call. I'll also warn you that I'm not an economist. I don't do gloom and doom or deal in predictions. In fact, there's a pretty good chance that I'll learn, tomorrow why the things I predicted yesterday didn't happen today. That said, we do track a plethora of metrics that are unique to SVN in the markets that we serve, and we of course, thoroughly researched the economic trends which underpin the commercial real estate industry, and we'll get after some of that this morning. As an aside, I really don't want to make this talk about COVID-19. Our view of the world has to be much longer. And while I appreciate the life-changing nature of this terrible virus, I think it's important for leaders, important for entrepreneurs, and certainly me to go through or see through the COVID target and elevate our business models, redesign them, and be positioned to thrive on the other side of the crisis. I don't want this to be a COVID and the real estate economy talk, but we've got to weave it in here. So bear with me in that regard because it's relevant. With respect to what I'll touch on, I'm going to focus on the major real estate food groups and provide an overview as we see it of the apartment, retail, office, industrial, and hotel product types. And while I recognize that we have a diversified audience of owners, developers, and even users of commercial real estate, for the sake of time and focus, I'll spend a healthy portion of my time talking about the investment side of the business, property values, and how that drives a number of other downstream factors like rent and other features which will affect and impact everyone in the room. I think if we start at the investment and capital markets level and work our way down, everyone will benefit from the content. And while I'd like to provide you with some firm predictions as to what the near-term future holds, that's something that I'm not even going to attempt to do this morning. We feel terrific about commercial real estate as an investment vehicle in the median and in the long term. Its place in the investment race has been recently cemented and it isn't going anywhere. As for the near term, look, nothing about this year has been normal, nothing. And the best forecast I can give you for the next 6 months is probably to affect some more abnormality. The way consumers act is and will be different. The way we travel is and will be different. And demand for commercial space, whether it's office or for investment, is and will be different. That said, opportunities abound. So let's go to slide 2, if we could, and sort of level set here. And for context, bear with me for a bit of ride down memory lane, and let's track back to the start of the year. We are on the heels of record economic expansion, rising sales volume, rising pricing for all commercial real estate product types. And in fact, in all of 2019, some 600 billion of sales volume traded hands, which is about even with previous records set in 2018, 2015, and you remember way back in 2007. So the market was incredibly strong. But there were, pre-COVID, early signs of a market slowdown. So foreign direct investment was off by about half. Q4's trading activity in 2019 was off by 7 or 8%. So velocity was down a bit. And while the market was past its peak, the anticipation and everything that we were thinking about and talking about was that a modest, if not a healthy correction would take place. Zooming out further from a macroeconomic standpoint, every month, and I consume this like clockwork, the Wall Street Journal conducts a survey of the nation's leading economists, ranging from Goldman Sachs, Morgan Stanley, you name it. And in January, a group of roughly, 75, 100 economists were upbeat. So phase 1 of the trade deal with China was newly inked. The number of job openings outnumbered available workers, and the stock market continued to sort of press new highs. And so when those economists were asked about their economic forecasts, only 14% believed that a 2020 recession was in the cards. And, please excuse the play on words, but this year has truly brought a whole new meaning to the phrase, hindsight is 2020. Then COVID hit, and its disruption to the labor market, both in terms of scale and pace, has been unparalleled. And I think we need to level set here. And I'm telling you and reiterating and repurposing things that you've probably already heard, but I think it's important that we start here. So bear with me. In the Great Recession of late 07 through mid 2009, a total of 37 million jobs were lost. And at the time, it seemed as though the economy was, falling a mile a minute, if you remember that far back. Needless to say, the ideas around how fast the ground can crumble has adjusted over the last 3 months. So it took just 9 weeks for the number of initial claims in the COVID shutdown, unemployment claims, to eclipse the total sum of the last financial crisis. And to date, more than, I think, close to 50 million initial jobless claims have been filed. Yet the number of jobless claims is coming down every week, which is indicative of some solid improvement. And we should recognize small wins like that. So looking back to 2 months ago, a few other data points I want to give you here to complete the foundation building. The civilian unemployment rate skyrocketed in April, reaching a high of about 14.7%. And total unemployment may actually be 1 out of 4. It may be 20 to 25%. That's a level that we haven't seen since the Great Depression. So a little bit more, making things a little bit more complicated. Quirks in how the Bureau of Labor and Statistics, the BLS, conducts its survey may have actually made the numbers appear rosier than reality. So the BLS physically calls businesses, and in order for them to count a layoff, it requires a verbal confirmation from the employer on the line. And while this method generates accurate results under normal circumstances, it's got a fatal flaw, which is voicemail. So still, despite the fact that we need a pretty big grain of salt to accompany the official unemployment numbers that we both consume, keeping an eye on the way the rate moves provides important clues about the labor market's health, which of course are incredibly relevant to commercial real estate. And here's an encouraging sign. According to Bloomberg, the consensus forecast for the unemployment rate was to rise by 5% in May, and instead it fell by 1.4%. So you can see that tick south on the right side of the graph there, signaling that. Can you go up a little bit? Next slide. Yeah, there you go. My apologies. You can see that tick on the right side. Now, I wouldn't quite call it a rebound just yet, but we have managed to stop the bleeding, and we should celebrate that victory. Next slide, please. I'm often asked, what's closing? What's closing in the middle of this crisis? What are the clear under contract and closing trends? Where's the action? And I think that early in COVID, it was absolutely, we were dealing with a period of total paralysis where, touring space or completing physical due diligence or even notarizing a document was nearly impossible to do. And I will tell you that the commercial real estate ecosystem, and this is a positive, which was once mired in the Stone Ages with respect to the adoption of technologies supporting other large industries, is by and large today set up to work on and even close on transactions partially or completely remotely. And I think if COVID hit 10 years ago, I think we would have been paralyzed for a much longer period of time. And depending on where in the country you are, as states move forward with their phases of openings, and some I recognize are taking a step back, and I think the fits and starts growth patterns that we're going to see across all metrics will rule the day. Velocity is picking up rather quickly, and I'll get into some of the data that we're seeing throughout the call, especially where the thinking and the investment theses are appropriately medium to long term. So one of the pieces of advice we're giving our clients is that making real estate investments based on short-term sentiment or panicking is an absolute mistake, in our opinion. And as for what's closing, well, I'm sure this is going to frustrate you a bit. While the products like quick serve single tenant net lease, which is proving to be pandemic and even recession resistant, are closing in droves. And multifamily is very active and stable, which we'll talk about momentarily. We are seeing steady sales volume across all product types. So there's certainly some beacons that I'll talk about, but we are seeing all product types close with the exception of a few, namely hospitality. So on your screen is a snapshot of some in-crisis closings, for lack of a better way to put it, like an $11 million property in Tucson, Arizona. Multiple asset classes are changing hands in that part of the world, with sellers finding valuations and buyers hanging on to fundamentally strong deals and transactions. Just over the last couple of weeks, we've seen multiple closings, like there's a 22,000 square foot medical office image on the screen, a suburban retail strip center, and even a $2.9 million property that houses a brewery, which reminds me of Evo in your neck of the woods. So the other side is that transactions are getting started and new listings are hitting the market. And that's a challenge, as we do have a price discovery issue. And we recently listed, for example, a 548 apartment unit deal in 5 properties, all built in the 1980s. So good, solid B assets. The seller is realistic about current circumstances, but he's interested in selling as a portfolio or separate. And so, not to generalize here, but I have to, whether it's a luxury resort listing in the upper Midwest, a single family resident portfolio in Central Florida, development land just sold in the CBD of Phoenix, or a large industrial property in Chicagoland, we are seeing a large number of new properties enter our listing rolls, which is a marked change from only 2 months ago, and where sellers are coming to the market. So 2 encouraging signs of growth and progress that we're tracking here at SVN. Let's leave the slide here for a minute. Let me get into some of the product types. So let's talk about apartments and the multifamily sector in general. And as I mentioned, this category has stood as somewhat of a surprising beacon of stability. So the labor market shock that we're dealing with had no precedent. And there was a building fear that in mass, renters of apartment units would be unable to make monthly payments, risking the solvency of countless landlords. And that didn't happen. Instead, what we find is that where renters have maintained the ability to pay, they have prioritized doing so. So even in cases where they're protected by a local or federal eviction moratorium, they're paying rent. And the National Multifamily Houses Rent Tracker, which surveys collections from 10 or 11 million apartment units across the United States, tends to be more reflective of the top end of the market, more of the quasi-institutional and above type products, but still it's a useful benchmark. And in terms of rent payments and collections, for the full months of April and May, collections came in just 3.1% and 1.5% below their prior year levels, respectively. Through the 20th of June, which I looked up yesterday, rent collections are directly in line with where they were the same period last year at 93%. Although, in all fairness, there has to be some slow pay. There has to be some no pay increases once the CARES, the $600 unemployment benefit, ends later this month, which is something that we're watching very closely. But apartments are trading. They are being viewed as by our clients as a growth and capital preservation investment strategy, especially at the local level with respect to non-institutional properties. In fact, taking all apartment price cohorts into consideration for a minute, according to Real Capital Analytics, deal volume, velocity for apartment properties in the month of May sank 81% from a year ago. That is with respect to all comers and heavily weighted towards the institutional side. Interestingly, our experience at SVN, where our focus is working with private investors and families, is significantly more positive. And so while we saw a year-over-year decline in multifamily velocity in May, it was in the range of about 25% instead of the all-comers rate of 80%, another encouraging sign for everyone on this call. Next slide, please. Okay. Looking at all product types for a minute here in terms of pricing. Volume in April and May, and volume and velocity can sort of be used interchangeably, plummeted with hotel and retail seeing the biggest hits, and that's no surprise. So you can see the dramatic shift on the right side of the bar graph here. A few headlines for you. The H1 statistics, the statistics for the first half of the year, as a reminder, won't be as bad as you think because of an incredibly strong start to the first quarter. Smaller deals in the middle of this crisis have been more affected than larger deals over the past 60 days. And as for distress, signs of distress, the next wave of distress that we're all talking about, it just isn't happening yet, as distressed sales only account for 3% or accounted for 3% of all closings in May. And while there are reports of potentially troubling assets skyrocketing, lenders are signaling that they are going to be relatively quick to forbear, at least on the front end of this economic cycle. Let's talk about pricing, which is inevitably on your mind. I'm asked about this all the time. Where are prices headed and when? And in terms of all income producing property types, we do have a bit of a price discovery challenge on our hands. And if you track back to your, to reduce it to the ridiculous, your Econ 101 class as an undergrad, in order for a trade to occur, there needs to be some cross section between what a buyer is willing to pay and what a seller is willing to accept. And we see a whole lot more daylight between a buyer and a seller's opinion of fair value. And that slowed the volume of trades quite a bit, and it should. I mean, when a potential seller is presented with the two options of either dramatically marking down their asking price, right, from only 3 months ago, or weathering the storm, waiting for liquidity to return and try again in the near future, they'll do that. Absent any distress or inability to obtain financing, they'll do that. So, and to put this into perspective, the team at the MIT Center for Real Estate, just down the street here in Cambridge, I'm in Boston, that's what's in the background, by the way, estimates that valuations in most of the commercial real estate categories are that valuations would need to fall by between 5 and 8%, which is not that significant, in order to restore normal levels of transaction volume. And so we view that too as a positive. That's your delta. But price discovery currently remains a challenge. In terms of cap rates, I'm confident that there's going to be a delta and a divide between the haves and the have-nots with respect to cap rates. So on the one hand, the pandemic will negatively impact rates in property pricing as new layers of risk are underwritten. That's clear with respect to many product types. On the other hand, if as an owner, you have a reliable stream of income, which can be locked in by an investor, long-term, in the future, investors, in our opinion, will accept very low yields for that. So in some cases, we're seeing cap rates poised to go way down, which may be counterintuitive to some of the data that you're digesting and consuming. So for example, if investment grade spreads are 75 basis points, you might see an unsubordinated ground lease deal trade for a 2 cap in the future, preferring that stability over chasing that high yield, which has been the goal of many investors over the last 10 years. And this reminds me of what we saw during the Great Recession. And while it goes without saying that comparing what we're dealing with now and the COVID shutdown and the crisis of 2008 is a classic case of apples and oranges, still we can expect some of the recessionary effects to be similar this time around. All else being equal, in periods of economic stress, many sort of would-be homeowners have more difficulty obtaining mortgages, pushing excluded households back to the market for rental housing. And both apartments and another category that I want to bring up called single-family residential will benefit from that. And I think it's important, by the way, as I weave these bright spots in, to keep in mind that they're there and to take note of what they are, and to keep in mind that opportunities arise from crises like this. And from an investment perspective, from the standpoint of redesigning your assets or your development plans to appeal to the new normal, times of crisis represent golden opportunities to scale and to build wealth. And we're spending a lot of time with our clients on developing their near and midterm strategic plans on that front. The Kauffman Foundation sponsored a 2018 study which found that more than half of the companies on the 2018 Fortune 500 list were launched during a recession or a bear market. So I encourage you to see this crisis both as a moment, as a vintage, an investment vintage, which is what we've been referring to this buying opportunity as something friendly to new acquisitions, as well as an excellent opportunity to take significant market share, be it in a geographic location or for tenants or for redesigning your business models and investment strategies. And I'm I'm diverting here and standing on a soapbox, but I do think it's important that we work that way as simply weathering the storm and coming out of this thing, battered and bruised, but alive. Well, that's an accomplishment, but it quite simply isn't bold enough or big enough thinking, in my humble opinion. So I was on apartments. With respect to apartments, with the exception of some of our largest cities, where housing density and mass transit dependence are nascent concerns, the apartment sector stands to remain strong through the balance of the COVID recession, in our opinion. Just want to touch on sort of apartments and residential portfolio products in suburban America, which is essentially where you are. That is an area where residential housing is not only surviving during COVID, but is thriving. So I mentioned earlier single family rentals and more specifically build to rent communities. This is an emerging institutional asset class that we are at SVN are exceedingly high on. So we're talking about portfolios of single family residential homes and new construction of build for rent. We call it BFR portfolios, rolled up into large and small pods of homes and traded. Investments in this space we're on target to surpass $3 trillion in the coming years. Single family residential trading velocity has actually surpassed the multifamily segment for the last 5 years, and it does remain the top CRE investment class. And I can tell you, based on what we're seeing at SVN, that there is insatiable demand for SFR rental homes. And according to Freddie Mac, the growth of the sector is expected to continue to outpace multifamily over the next 3 to 5 years. And let's stay on this for a minute, because I think this is a classic example of finding opportunities amidst the disruption. Sort of be aware of the danger and navigating through this crisis, but recognize the opportunity. Approximately 40% of Americans rent today. And for the remainder, those who currently pay a mortgage, 2 out of 3 homeowners are considering renting in the future instead. And now these were trends that were in place pre-COVID, and like COVID's done with many other trends and product types, these trends have been accelerated. So in fact, 3 out of 5 living generations prefer the option to rent versus buying a home in the upcoming years, according to surveys. And it's easy to understand why. In many cases, they want more livable space. And COVID's impact on all of this is really just cemented that trend. So in build to rent communities, renters are able to access quality public schools and at attractive balance of space and take advantage of sheer amenities. And moreover, they're able to do so without incurring the hurdle costs associated with home ownership. Now that many of the cities and states are implementing their phase 2 and 3 growth plans and other lifestyle amenities that define city living have sort of reemerged, we're seeing a lot more households say, hey, we're planning to move out of the city in the next few years anyway, why not now? And there's opportunity, especially in suburban America, to capitalize on that trend. So apartments and certainly single family residential are areas where there are ample reasons to be bullish right now. Let's talk about industrial and retail and go to the next slide, please. Oh, next slide. I'm sorry, I skipped over the single family. Yeah. Okay. So right now, the industrial sector is one that if we rounded up at random, any 10 commercial real estate professionals and asked for their take on the asset class, we'd be given 11 ringing endorsements. And that's for good reason. So between 2015 and 2019, online shopping grew by an average of 13% a year. A little less than 2 weeks ago, the Census Bureau released the monthly figures for April, which showed that e-commerce was up by an incredible 29% from a year ago. Now, of course, in context, April's jump makes complete sense. Fewer physical retail stores were open, and in cases where they were, many individuals just chose not to go there, and they preferred to exercise caution and stay home. A transition from brick and mortar consumption to online retailing is not only continuing, but it's picking up considerable steam. And this is yet another example of COVID accelerating a clear trend and an edible result. So, those few online shopping holdovers, my parents were two of them, out of sheer necessity, were forced to place their first few Amazon or online grocery orders. They realize that it's not very complicated and they're likely hooked. And so the impact of that consumer behavior will have ripple effects throughout industrial and retail real estate. For the month of May, trading activity, sales for industrial assets are down from a year ago, though the expectations gap between buyers and sellers is the narrowest compared to other product types, according to Real Capital Analytics and MIT. Industrial is yet another beacon of stability. Measuring transaction volumes on a year-to-date basis, industrial is also the only product type of the major food groups still on pace to eclipse 2019's totals, which is remarkable given what we're dealing with. And again, industrial's place in the race is most certain to stick. We are bullish on that product type. So industrial was the relatively preferred asset class last year, remains that today, with changing supply chains and a forced acceleration towards e-commerce. COVID has sort of highlighted the industrial sector as one that'll continue to be of critical performance as we navigate through this cycle. On the flip side, let's look at retail. And returning, to those 10 commercial real estate professionals that we imagined up and polled at random, we can probably guess how they might be feeling about the retail sector these days. And according to estimates, the US has about 23.5 square feet of retail space per capita. That's 40% more than the next most densely retailed country, which is Canada. In Europe, no country has even 5 square feet per person. And while Europe might not be a good comp for the US because of huge differences in lifestyle, Canada, at roughly 17 to 20 square feet per person, is. Any way you slice it, we have more retail space in this country than what we need in a modern economy. We are simply over-retailed. According to TREPP, more than 10% of retail loans that are CMBS oriented are delinquent. That's a marked increase of more than 100% from last year. Tenant non-performance and the continuing wave of retailer bankruptcies certainly adds fuel to the fire, making more space available in a sector that was already trying to become less over-retailed. That is a significant economic headwind. And on the flip side, again, of course, where there is distress, there are opportunities. So risk premiums are spiking. There is limited access to debt financing on this front, but opportunistic investors who both know how to navigate this sector and repurpose real estate and can raise cash are incredibly well positioned to find an abundance of discounts in this investment vintage. Now, at the same time, many segments of retail that we regularly list and market remain strong. At SVN, we're seeing general merchandisers and grocery stores performing well. Both Home Depot and Lowe's outperformed expectations, at least on the consumer side. And what we're seeing is that retailers that sell items that people need quickly, want to touch, have remained relevant. While many of the retailers that are large and national in nature, others that are neighborhood businesses and tenants in the strip centers that dot the landscape across the country are experiencing a different set of challenges. Another sticky retail factor is what we often lose, and we often lose sight of this, is that when a retailer goes out of business, those sales go somewhere, and they generally go to a stronger center, maybe to a slightly less convenient place. So keep that in mind as you talk about, the role of e-commerce completely disrupting the role and the place in the race that retail has in commercial real estate. So if a nail salon goes out of business, people aren't going to get their nails done virtually. They're going to go to a different brick and mortar location to get their nails done. Another encouraging sign that we're seeing is that the credit markets have not shut their doors to retail borrowers. Financing is available. So preliminary RCA data for April and May shows refinancing activity for retail assets down about 65% versus a year ago. That's actually a bright spot for the sector. And over the long term, retail will, of course, continue to shake out. Over the near term, as long as the country continues to move along a path of reopening, retail does stand to be a primary beneficiary. After retail sales posted their worst monthly drop ever in April, they jumped by their all-time highest growth mark of close to 20% in May, another encouraging macroeconomic sign. Let's go to the next slide and take a look at the office market. Right there, perfect. The office sector is and will continue to face its fair share of logistical challenges in the coming months. So though the jury's still out on the long-term effects of COVID on commercial real estate pricing and sales volume of office properties. And the result of that is that office trades have, for now, temporarily paused. So how will this shake out? How will the great work from home experience affect office demand in the future? Should companies lease more space to add social distancing capacity into the workplace? Another way to look at it. Are landlords liable if tenants contract COVID at their property? It's sufficient to say that there are a lot more questions than answers right now, and the sector has responded by collectively sort of hitting pause. Now, the early observations that all of us made in working from home and being seemingly more productive and saying to yourself, hey, I can do this over the long haul, have, for many of us, after we did this for 2 or 3 months, been replaced with, do I really want it this way? Is working from home all the time a healthy thing to do psychologically? Is the work-family blend, good for my family? And I think my point is that the early calls for, increased productivity at home, and thus we don't need as much office space in the future, were a bit overblown. But for now, there's this wait and see mentality out there on the office side, which is supported by some findings that NAIOP released last week. 64% of the folks they surveyed, of the real estate professionals they surveyed, reported no new acquisitions or developments or redevelopments in the market in May. And for those who were reporting any new developments or deal flow, the overwhelming majority worked on deals to acquire existing properties. Moving forward, the demand, and this is a couple of things that you can think about as an owner, developer, or broker. We predict that the demand for new luxury product will be more sought after than existing stock. And the difference today is that some of the high-end design amenities that were in the sort of nice to have bucket a few months ago are now quickly becoming the peace of mind features that can get tenants comfortable with the idea of returning to the workplace. And according to data from CoStar, 4- and 5-star office buildings accounted for just under half of the gross leasing activity from January through mid-May of this year. And we expect that tide to continue to move in that direction. So operators, property managers, owners that are able to implement, temperature screenings, additional cleaning services, and top of the line, air purification systems will have a leg up on the competition as the search for the new normal begins. And we're advising our clients, to think about wider corridors with one-way foot traffic. Again, better air filtration, touchless elevator controls, antimicrobial materials and new construction and video conferencing, even within the office, all of those things to address both the near COVID concerns as well as the new normal, as well as the 2, 5, and 10-year market that we're going to be dealing with in the future. Here's another trend that we're seeing at SVN, which is relevant to the geography in the Eastern Shore, and that is with respect to households. So households, certainly a trend before COVID, absolutely in place now. are trying to de-densify their living arrangements, and they're setting their sights on, metro adjacent suburbs and away from primary coastal markets. I read a statistic earlier this week that according to Redfin, searches for homes in smaller cities and towns were up by 87% in May. And what we're seeing with some of our tenant rep assignments is companies taking a much harder look at suburban office. Larger floor plates, low dependency on elevators, if any, and even an appreciation for tenants having the ability to actually open windows for airflow. So some of suburban offices' design elements and features may be at a premium given where we are in this crisis. Slide 9, let's talk about hospitality quickly, and I'll take about another 5-6 minutes before questions. So if anyone listening to me deserves a vacation, aside from my wife, it's my friends in the hotel sector. The day-to-day nature of a hotel's leasing structure made the sector, of course, particularly vulnerable when the country sprang into a lockdown. National hotel occupancy rates sank as low as 22% in early April, while daily rates are still in the bargain category if you've searched at all for price discovery, or you've elected to take a local vacation. We're not seeing the summer peak that we've seen in the past for obvious reasons. And from the April low, hotel occupancies have actually risen in each of the 8 weeks since then, jumping by a relative 75 to 80%. And of course, this is a national picture. We are seeing localized hotspots across the country that are performing exceedingly well. So in some cases, even better than they were during this time last year. So it's unclear whether hopping on a plane for your summer vacation would expose you to any more contagion risk than you might experience in your day-to-day life. We're fuzzy about that. What is clear, though, is how potential travelers perceive this risk based on the number of passengers screened at TSA checkpoints. Domestic air travel is currently operating at just about 20% capacity. So instead, travelers who are itching for a summer getaway are turning to driving accessible locations from West Palm Beach to Panama City, markets less dependent on air travel that have an attractive set of summertime amenities, like where you are positioned well to see a bump in regional demand. Social distancing, by the way, and travel aren't incompatible. So cottage-based resorts and rental home properties are booked up in many parts of the country as people choose to take their vacation, but do it in a way where they can remain a little further away from everyone else. RV rentals are up by 650%. Boat sales are incredibly healthy, pointing not only to healthy demand for those who have vehicles to rent out, but also boding well for campgrounds and other alternative types of hospitality properties. So long-term, hospitality will rebound, and some are saying it'll do so quite sharply. I think it was the CEO of Airbnb who said that before COVID, we played on our screens and we worked in hotels. And after COVID, that'd be inverted. After COVID, we'll work on our screens more and play in hotels. So bodes well for the recovery of the market. Let me wrap up here with a few comments. So when the widespread outbreak of COVID became inevitable in mid-March, markets were bombarded with information. And effectively, there was a week's worth of price-moving news coming across our screens every single hour. Now, while the waters feel a bit calmer than they did during that initial shock and awe period that we all experienced, we are still operating in a period of extreme economic anxiety. So COVID's first wave has yet to fully work its way through several parts of the United States. Social tensions are at an all-time high, and I think there might be an election going on. I do, however, think that we have a better idea of what the possibilities moving forward are today. In many ways, we've taken a lot of that initial uncertainty and repackaged it as risk, and that's being reflected in shorter periods of price discovery. Last slide I'll speak to. Looking at personal mobility data, this is an encouraging sign reported by Apple Maps, which I look at all the time. We see that Americans are, again, pretty willing to hop in their car or stroll down the street. So, convincing people to hop on a subway or a bus again anytime soon, well, good luck with that. But while the information is changing rapidly, we are seeing society get back to work, get back to shopping, but just do so more intelligently than they were early on in this crisis, if I could put it softly. There are a number of decisions that the government is going to be making on a number of fronts, which are going to impact all the content that I just went through over the last 45 minutes, like the $600 government top-off. That'll have a meaningful effect on real estate. You also have a significant number of recent college grads who would normally get jobs this summer or fall, and they may not get jobs for 3 to 6 months, and that will have a temporary impact on things. So at this point, Wes, I've gone a little bit over time. I'm gonna take a pause here and see if there are any questions for me.
Absolutely. Thanks, Kevin. So informative, so much information to absorb. Thanks for your time. We know you have a busy schedule. So what I normally do with our audience here to recap a couple bullet points that I take down to summarize. So just a couple things that I wrote down, certainly not going to go through all the points here, but some major points. Rent collections remain high at around 93%. I believe you're focusing on the multifamily market there. There has been falling deal volumes, of course, that was expected across all product types, ranging from down 62% to down 95%. However, this is the first time I've heard this information, so thanks for sharing this piece. It is estimated that prices will only need to fall between 5 and 8% in order to restore those previous volumes. So to me, I thought that was very encouraging news. A couple more points here. Relative to most of us on the call today and that we interact with, suburban America has a thriving residential market, including a newly popular product type, SFR portfolios or single family rental portfolios. And then another stat I had not seen yet, thanks for sharing this one as well, 2 out of 3 homeowners are considering renting in the future. I had not heard that stat yet. So that is very enlightening, especially for those apartment and SFR developers. Industrial retail. Industrial remains a strong asset class. And as far as retail goes, the biggest thing I took out of your presentation is people are not going to get their nails done virtually. So thank you for that insight as well. Not yet. So that's enough of the recap. I'm going to jump into some questions here. We probably have about a dozen. So those that are listening, we are going to go over 11 o'clock, but it's not every day that we have the chance to speak to a CEO of an international company. So we are going to maximize our time as long as he allows us. So one question coming in. You touched on some of it. Most of what you touched on that I saw was historical, dating back either to the last, say, several months and maybe even the last few years. But looking forward, what is your outlook on the velocity of commercial real estate transactions for the rest of 2020 and then over the next 12 months as we move forward?
Yeah, so one easy answer is that volume and velocity are going to pick up from here forward, and we're seeing that. The flip side to that, though, is that happiness is a low base. We saw at SVN and RCA reported nationally a record number of deals falling out of contract in March, and those could be sales contracts, those could be leases that were under letter of intent. But our net new under contract data for May and June is very positive, and many more deals are going under contract, are in escrow, than are falling out of contract, which is an indication of increasing velocity this fall. But as I said, this is a fast-moving and dynamic situation, and the election's on the horizon. A vaccine is on the horizon. And so the next 6 months are going to be frenetic, in my opinion. That said, opportunities are there in many instances. So the next 6 months are going to be fuzzy. I expect rising sales volume and velocity. Long term into 2021 and beyond, I expect to see a progression and an eventual return to an extraordinarily healthy investment sales volume level, given commercial real estate's cemented place in the investment universe. There has never been a greater appetite on behalf of the private investor, even the non-high net worth investor who can invest in commercial real estate through crowdfunding than ever before. So we're seeing the democratization of commercial real estate data and investment opportunities, which is a very powerful global force, much more powerful than a market interruption or even the COVID crisis.
Thank you, Kevin. We have a lot of questions coming in, so we're just going to go through these as quickly as possible. Rick has a question lined up.
So we have a question here from Clark Kent. So it just shows you our reach here. We reach Planet Krypton with our viewers here today. So John Kent, thanks for this question. So rent collection for multifamily somewhat is stable. What about restaurant bar segment? Can you comment? And real quick, I'll comment it from, we do property management here, and just as the mom and pop shops, we've been actually okay with collecting. A lot of them got PPP money. It's I won't call it an issue, but where we're negotiating deals with is actually the national restaurants getting their rents. They're not trying to not pay rent, but we certainly have to work it out, and they're very worried about the future of their business. So they want to step it back here for a little bit. But what is your take on a national level as far as rents being collected from that segment, Kevin?
Well, and I'm not a restaurant expert, and I would defer to you for more granularity, but it's undoubtedly among the most challenging of real estate classes, if you will, right now for obvious reasons. And I know that there, unfortunately, it is a trend emerging where restaurants have taken the PPP and have, no intention of reopening simply because they can't. I'm concerned about the sector. I mean, there's a reason restaurants are closed on Mondays, and that is because they can't make any money at 25% capacity, and that's what they'd end up experiencing. So certainly something that we're going to get greater clarity on over the next 6 to 12 months. But rent collections are going to be dismal, if not scary, during that period of time.
Yeah, and unfortunately, restaurants were kind of the first ones to get hit by all this. They were, in our area anyways, the last ones to kind of ease up on, and then some of these spikes they're already talking about locally here at one of the resort areas. They're talking about closing them down again for the 4th of July, which is they'll be the first again to be hit. So tough segment to be in right now, but most of them are holding on. So run out short of time. Next question.
Got another one that you haven't touched on yet, Kevin, and we are going to do a hard stop at 11:04 for you guys watching. So real quick, can you touch on any changes that you've seen or been hearing in the capital markets? I know I've personally experienced and seen some tightening in that arena, definitely with a more risk-averse approach.
Yeah, and the challenge there, of course, is price discovery. And I mentioned that we moved from, trying to figure out where the water cooler is, just trying to figure out what we're dealing with, and that initial uncertainty. And we have, as I mentioned, repackaged it as risk. And the difference between risk and uncertainty is, of course, that markets can price risk. Just take a look at CMBS. Thankfully, AAA spreads have returned from the moon after reaching highs in excess of 330 basis points over swaps. So efficient pricing has returned, and spreads are once again below 130 basis points. The other comment I'll make about the capital markets right now is not many product types are shut out. And for good quality deals, there is financing. Refinancing levels remain healthy across all product types. Another bright spot in the credit markets.
One last question here. So everyone always wants to know, Kevin, can you tell us when the bottom of the market's happen and the top of the market's going to happen? No, I'm just kidding. So
I wouldn't be here. I'm going to go place a bet if I know the answer to that one.
So as a CEO, this is from Flo Adams, as a CEO of a major national company, what do you personally keep your eye on as an indicator, for the market? What's the one? I know we're running out of time. This could be a long answer here, just a quick one. What's the number one thing that you're looking at, or number two things that you're looking at as indicators?
Gosh, as indicators of the market's health.
Yes.
It's easy. It's and we look at a number of metrics like days on market, of course, net new under contract, which speaks to a narrowing of buyer and seller expectations. But the one thing that I get concerned about, because we're in the transaction services business, and while we work to generate clients for life, that's how we generate revenue. And so I look for the shrinking daylight between a buyer and a seller. And right now it's understandably too long, and quite frankly keeps me up at night. All the indications that we're looking at across all metrics, even though happiness is a low base, is that those gaps are narrowing. I think that we'll get much more clarity very soon. So one of the negatives associated with this fast moving crisis is that we are taking in information faster than we can digest it. We are taking in information faster than we can develop plans for, specific to the information that we're taking in. The other side of that coin is that on the other side of an election, as we gain greater visibility and confidence in the development and distribution of a vaccine, things can change very quickly. And remember, underpinning all of this is commercial real estate, the gold standard, a tangible investment, which, aside from crises like the one that we're dealing with now, features relatively predictable income, is a hedge against inflation, and has now been democratized. So you can invest, as little as $10,000 in an institutional asset. Those trends will counter the headwinds that we're dealing with now in the near term.
Thank you, Kevin. We're going to go ahead and let you sign off and go. We have a lot of questions left, but we'll try to answer those after this. But one person did ask, how is the commercial real estate brokerage industry and SVN adapting to the current market? And I know that is a question that is probably right up your wheelhouse, but I'll just kind of touch on that real quick, and then we'll let you go. We're doing everything that we possibly can, primarily with communication. Communication is number one key that I hear from the clients and customers that I deal with on an every single day basis. The biggest complaint they have is lack of communication from their advisors. And I know from a corporate standpoint, Kevin and his team have been doing a tremendous effort in providing us those tools to adapt to this market and communicate with our clients with the latest information possible. So Kevin, again, thank you so much. We value your time. Thanks for joining us today. And I know you have another appointment to go to, so I will let you roll. Thank you very much.
Wes and Rick and everyone else, thank you. It was a pleasure spending some time with you. See you soon.
Thanks, Kevin. Talk to you soon.
Okay. All right. Thank you, Kevin. I appreciate that very much, to take your time out of your day to speak with us. So once again, we would like to thank our sponsors. Without this, obviously, it would not be possible. Our sponsors are our clients, they are our colleagues, and they are definitely part of our community. So we do appreciate that as well. For all the attendees, if you haven't already received it, we do have a 2019 market report that we've given out. If you have not received it, you can email Amber, respond to her, and she can certainly email that out to you so you have that information. Once again, thank you for choosing this virtual meeting, as you have many to probably choose from. We appreciate it. And we do have one more series left over. It will be on July 15th. It's going to be a good one. This will end our series. It's the 6th and final one. So on July 15th at 10 a.m., we'll have a distinguished business panel in the presence of the main economic drivers of Delmarva, to include Steve Leonard, President and CEO of Peninsula Regional Medical Center, Dr. Charles Wright, President of Salisbury University, Randy Day, who is CEO of Purdue Farms, and Dave Ryan, Executive Director of SWED, Salisbury Wacomico Economic Development. So that'll be a great panel here on July 15th, 10 a.m. Please tune in. Again, we thank you for attending, and we'll see you in 2 weeks.